Okay, hi everyone. Thank you for coming back from our second break to listen to our second series of flash talks this morning. My name's Catherine Hillier. I am one of the research analysts at Marquette, and I lead our coverage of U.S. equities. I will be kicking off this series of flash talks with U.S. equity markets, trend or new normal. So to start today, we're going to present an overview of U.S. equity market performance post-pandemic. Then we're going to look at a couple of the key themes that have driven that performance. And we're going to close by considering whether or not those key themes might be reasons for a new normal in the U.S. equity market, or whether or not they're simply just the next trend. So let's start with an overview of performance. So since the pandemic, the U.S. equity market has been pretty eventful, but it's actually been very additive for client portfolios. In just the past 2.5 years alone, we've seen back-to-back years in 2023 and 2024 of over 20% returns for the S&P 500, but that was followed by a near bear market crash in April of this year, but then a subsequent rally that has led to new highs for the S&P 500 and will go down as one of the quickest in history. The outperformance that we've shown here on this chart indicates that in global equity markets, outperformance has really been concentrated within the US. If we think about the US equity market, the Russell 3000 is a good representation as it represents the broad US equity market. And here we see on the brown line that US equities have handily outpaced their international peers since the pandemic. Now, David will dive deeper into the performance between international and US equities to close our flash talks today, but for now, we'll stay focused on the US. Although this outperformance has been pretty significant, it has not been uniform across asset classes, and we'll see that there's actually been a pretty stark dispersion of returns across the different corners of the US equity market. Now, we can point to many themes, but we're just going to focus on a few that have driven the US equity market, and we're going to start with large versus small. So large cap equities are typically going to be your more established companies with stable growth profiles that will typically be a ballast within an overall equity allocation. Small cap companies, on the other hand, have the potential to generate stronger returns because these companies typically grow exponentially faster. But how have these companies fared since the pandemic? Well, it becomes pretty clear that large cap equities have been the obvious winners, but for very good reason. Large cap equities have been those solid companies that have posted superior fundamentals and have really, and maybe more importantly, driven technological innovation. The poster child for this is NVIDIA, a company that we may all know well, and one that's become synonymous with the AI theme that we heard about earlier in the panel discussion. Now, utilizing the Russell 3000 and breaking it down into its market cap components, the top 200 companies in the index are going to be your large cap companies, and the bottom 2,000 companies are going to be your small cap companies. As large has outperformed, we've seen a significant shift in the composition of the US equity market. Today, the US equity market is comprised of 75% in that large cap asset class, and because of large companies just simply continuing to get larger, more critically, small cap companies have given up a considerable portion of their market share, and they now represent just under 5% of the US equity market. That's well off their historical average of just about 8%. Now that we've highlighted the overview of performance, we'll dive in a little bit further to a couple of the themes that we've mentioned. So by now, we may all agree that large caps have outperformed small caps, but markets typically move in cycles. And if we look at these cycles historically, we see that this one is pretty long, at currently just over 10 years of large cap outperformance. And that sets the stage for one of our key arguments for the market environment today being a trend, and that's mean reversion. Some investors will want to argue that this cycle is long in the tooth and that it might be poised for a reversal. And we'll present both sides of that argument in the last two sections of our presentation today. Another of the notable themes looks at style leadership, and more specifically, the dominance of growth. Thinking to large and small, if you replace large with growth and small with value, the story rhymes just the same. Growth equities have been in a prolonged period of outperformance relative to their value peers, but for a lot of the same reasons we touched on, as those solid large cap companies that have led the market are mostly classified within the growth bucket. As markets have been driven by a smaller group of companies, it's probably no surprise to many here that another theme we have is concentration. Now, if we go back to the Russell 3000, we can see that 30% of the assets within that index are held in the top 10 companies. Now, that's a level that we didn't see in the dot-com bubble of the late 90s and early 2000s, and it actually sets a historical precedent dating back to the 1880s. But why is concentration a concern? Well, as markets grow more concentrated, newer risks are brought into the market, and that's specifically going to revolve around those top 10 companies. If we see any of these companies suffer from an earnings misstep or come under pressure from any sort of weakening trends, like the AI one that we have touched on, you may see a significant pullback in the market. Now, if we take a closer look, the reason for this unprecedented concentration becomes a little bit more clear. The green dots here show the contribution to return for the top 10 companies in the S&P 500. We see that nearly 60% of the return for the S&P 500 in 2023 and 2024 was driven by just those top 10 companies. Now, we'll take a look at these companies to see if this outperformance is precedented, but concentration in large caps has been it's been a common phenomenon for several years. But what has been more surprising is that the concentration pattern has emerged further down the market cap spectrum as well, penetrating the mid-cap and the small-cap universe. Now, this has surprised some investors and many active managers. And you'll see here that if you look at the performance for the equity markets year to date, mid-cap equities have actually seen a more severe concentration concern than their large-cap peers. So if you have an active manager within your equity portfolio that's been struggling, especially further down the cap spectrum, you may be able to point to the concentration and the thematic, even lower quality nature of the market that we've seen year to date and even further back than that as one of the reasons for that underperformance. Now that we've taken a look at how a couple of the themes within the US equity market, we'll see how those dynamics may possibly unfold from here. And we'll start for how that might mean we're in a new normal environment. And if we summarize our key themes, a new normal environment might be characterized by market concentration that spans the cap spectrum, narrow leadership that spans the market cap spectrum, increased concentration, and where small and value equities can no longer sustainably keep pace with their large and growth peers. One of the biggest reasons to suggest that we may be in a new normal is simply to look at the quality of the companies that have led the market. Large cap companies, those represented by the Russell 1000, have posted superior fundamentals and are of higher quality than their small cap peers. Now, quality can be a fairly esoteric term, but on this slide, we'll look at quality as higher returns on equity and better margins. If we look at earnings growth, which may help indicate stronger fundamentals, we'll see that earnings growth within the market lies largely among those top 10, or lies largely within the large cap asset class, and more specifically within a smaller cohort of companies known as the Magnificent Seven. Now, I'll also draw your attention to the green bar below the axis on the second chart here. This unfortunately shows that earnings for small cap companies, again represented by the Russell 2000, has actually been negative for the next 2 calendar years, and we'll touch on that again in a bit. Pivoting back to our market leaders, we can compare these to prior periods we've seen excessive concentration in the market. And the closest and most similar period we may want to point to is the dot-com bubble. During that period, the market was fueled by speculation. Very similarly to today, technology companies were trading at excessive valuations. But a key difference between that period in the dot-com bubble and today is that the companies leading the market are of much higher quality than they were during the dot-com bubble. Now, I won't argue that there aren't areas of speculation within the US equity market today, but the technology sector, and more specifically, those companies that are leading, are of higher quality. And if we break out the Magnificent Seven more specifically, we see that these companies are also of higher quality than even their peers, with stronger profit margins, higher returns on equity, and even lower leverage. If we bring the market cap dynamic back to the forefront, quality doesn't carry over to the small cap universe. The story is in fact the exact opposite, as quality within small caps has actually deteriorated. As a reminder, the Russell 2000 can be used as a proxy for small caps, and we'll see quality on this slide as the percent of unprofitable companies within that index. The percent of unprofitable companies actually peaked post-pandemic when a near zero interest rate environment led to a flurry of IPOs to the market and the emergence of the meme stock. Now, meme stocks are those that have attracted a strong retail following and are the market darlings of social media platforms like Reddit, but these companies are also typically of lower quality and unprofitable. But they did have their moment in 2021, and even the extreme steep or sharp rise in interest rates we saw in 2022 didn't see a significant decline in the percent of unprofitable companies in the Russell 2000. And if you pull that forward to today, this level still remains elevated. If you think about the Fed embarking on an interest rate cutting cycle, this percentage of unprofitable companies may even remain higher going into the future. So if you have a small cap active manager in your portfolio more specifically, another reason for possible underperformance has been the popularity of these unprofitable, lower quality, and meme type stocks. So AI was a dedicated topic to open this symposium, and we heard that it has been a major driver of the equity market. Despite the brief sell-off related to DeepSeek that happened earlier in the year, these AI-related companies have actually led performance for US equities year to date. AI actually became a focus within the market in 2022, at the end of 2022, with the launch of ChatGPT. But the beneficiaries have largely been large cap growth companies, and more specifically, those AI enablers we heard the panel talk about earlier today. And that's helped fuel some of the market concentration that we've seen. But AI, as it has become a more present component of our daily lives, it really has cemented itself as a theme within the market. But some investors will want to argue that maybe this is just a trend, maybe AI is in a bubble, and that the extreme amounts of CapEx spending that's being spent to develop AI, we can't make a strong case for the return on investment for that capital being deployed. But CapEx among the major hyperscalers has fueled the economic growth that we've been seeing, and it shows no signs of slowing down and is actually expected to increase over the next year. So to play devil's advocate, we'll now look at the dynamics that may suggest that the current market environment is simply just a trend. In the last section, we highlighted the superior earnings growth for large cap companies, and we briefly touched on the inferior earnings backdrop for small caps. As a reminder, small cap companies generated negative earnings for several quarters entering 2025. But as we see on this slide, there may be some hope as the earnings growth expectations for small caps in 2025 and 2026 is expected to be far superior than their large cap peers. But I will caveat some of that optimism to say that when we entered 2023 and 2024, I was a bit fooled, as lofty earnings expectations entering those years set up a good stage for small cap equities, but they were very sharply revised downwards in both of those years, and small cap equities did underperform. Again, to play devil's advocate, in just this most recent quarter, small cap earnings have shown some signs of stabilizing, and if that does occur, small caps may show some signs of performance turnaround. So bringing the leaders back into the mix, the Magnificent Seven companies contributed most of the earnings growth to the market in 2023 and 2024. And as earnings ultimately drives market performance, there may be good news for those investors that want to think that we're also in a trend market. I'll draw your attention here to the green line, and this shows the earnings growth differential between the Magnificent Seven and the rest of the companies in the S&P 500. As we can see, the Magnificent Seven is expected to see earnings growth slow down, while the remaining of the companies in the index are expected to see a gradual increase in earnings growth. Now, if this pattern does unfold, then that should support broader market participation. We can look at the equally weighted S&P 500 index as a decent indicator of broader market strength. In those very narrow periods in 2023 and 2024, we did see the S&P 500 outperform the equally weighted index by over 10%. And in that time period, just 30% of companies outperformed the broad market. Now, if earnings breadth does occur, as it suggests on the first chart here, then we may see the number of companies that are able to outperform the market increase. And if that does increase, then we may be able to see some of the elevated market concentration start to wane. So if we again remove the impact of market concentration and take a look at the equally weighted S&P 500 index relative to the small cap universe, the Russell 2000, we actually see at the bottom here that the small cap universe has kept pace with the equally weighted version of the large cap universe. So maybe that suggests that small caps haven't been in as bad of a period as we might have thought. And to again pull things forward to today, small cap equities are actually expected to outperform the large cap universe in the third quarter. And although it might not be that bold to try and predict that we're actually going to be in the start of a turnaround period for small cap equities, because we will need to see the earnings growth that we talked about a couple of slides ago come to be in order for small caps to sustain this level of outperformance. Now to transition to macro influences, the leaders are mostly multinational companies that generate a significant portion of their revenues overseas. Large caps generate 40% of their revenues internationally, while small caps sit at just 23% of revenues. But why does this matter? Well, I'm going to think about one term that many of us have heard this year, and that's tariffs. So the effective tariff rate has increased sharply in 2025, and that's shown by the blue line here, and that data is actually as of April. So this has actually shifted even higher in recent weeks. And so in that environment, with this tariff regime, with a higher effective tax rate, those large cap companies, multinational companies that are generating more of their earnings overseas, may be more susceptible than their small cap peers. So shifting gears to the growth versus value debate, and we'll see valuations look fairly attractive for value equities. They're trading at a historic discount to their growth peers, while growth equities are trading at near historic record levels. So there are valid reasons for this, which we have touched on, being the earnings growth that we've seen among large cap equities, as well as the technological innovation that large cap equities have been driving. But mean reversion on the back of easing monetary policy may help see this valuation gap narrow, and value equities may have a chance to play catch up. So to close, an allocation in US equities has generally been additive for client portfolios, but the dynamics within the market has reached extreme levels. How might the equity market look moving forward, though? If you're in the camp of this is a new normal, you might point to the fact that large cap equities are more established, stable businesses that are continuing to generate strong, albeit somewhat slower earnings growth, and that technological innovation shows little signs of slowing. And all of those things together will help continue to fuel market concentration. If you think we might be in more of a trend environment, then you might think about the fact that other areas of the US equity market have shown some green shoots. You may point to the fact that small cap equities might be showing signs of bottoming, and that valuations trade at near historic discounts for both value and small caps. And you may be in the camp of more that the AI theme is in a bubble, and it may be poised to burst. So I personally believe that it could be a bit of both, and that the markets may fall somewhere in between. I think there's plenty of room for some of the unloved asset classes to play catch up, which may soften some of the trends that we have seen. But I think the quality of the leading companies in the market today and the technological innovation that we're seeing will help maybe avoid some of the steep reversals that we've seen in the past. Thank you very much for bearing with me today. Up next will be Amy Miller and Chris Caparelli for private equity in 2026 and beyond.